So look, this is going to be quite a hard video to put out because, as you know, a couple of months ago I put out a video saying don't buy AMC. Fundamentally speaking, the company is absolute horseshit and a short squeeze might well happen. Turns out it sort of did. But nonetheless, there is mega risk with this company. But last week, I went ahead and added AMC to my stock portfolio. And I think I have a very good reason to do so, and why I think this company could go up 2 or maybe even 3 times from its current price. I took a big deep dive into the numbers of AMC and found out the numbers are a lot better than I originally perceived. Their cash flows are fantastic, their revenues are growing, they're recovering quite well from the whole Miley Cyrus, and it's a matter of time before I make absolute bank on this company because it's severely undervalued. Now, before I give my full thoughts and thesis on why I bought into AMC, could you do me the kind favor of obliterating that like button until it turns blue? If you also want to learn my process on how I pick stocks, then do consider subscribing. But moving swiftly on, why the hell did I buy this company? So look, spoiler alert right now, I'm not going to waste any more of your time. If you consider yourself to be an ape investor, you use Wall Street bets on a daily basis, or you really want to corrupt the system and destroy hedge funds, this video is probably not for you, because we're not talking about AMC cinemas, we're talking about AMC networks. But hold your horses before you click off and throw a tantrum and smash that dislike button, because I think this company could genuinely 2 or even 3x in just a short period of time. And if you are a subscriber of the channel, you'll know I very rarely throw out predictions in terms of a stock price, but I do genuinely think I could at least double my money with this one. But if you are still here and you just want my thoughts on AMC cinemas, I think the company is absolute dog poop, the fundamentals are crap, and it's a matter of time before this one dies and falls down to the pits of hell and will destroy retail investors' hopes and dreams of one day buying a yacht and making hedge funds cry. Let's not talk about that today, let's talk about what this bearded bloke just bought. AMC Networks. Ticker symbol AMCX. This company is the AMC Networks, where you've probably heard the phrase previously on AMC's The Walking Dead. You might be a fan of Breaking Bad, Better Call Saul. This company has a hell of a lot of shows and has a semi-decent business model. And I just really want to say a big shout out to the Patreons. One of the Patreons or one of the chat room members put this on my radar a couple of weeks ago. I was really reluctant to have a look at it because I just assumed a cable company, that's a thing of the past. And this really is more of a cable company than a streaming service. But curiosity did get the better of me. I dove into their finds, I did a bit of research, and I found out this company actually is great value. So big thank you to the chat room member or the Patreon, whoever it was who mentioned this one. And if you want to get access to our chat room or Patreon, there's some cool perks down in the description. But AMC Networks is a cable company, and again, they've got a big roster of shows like The Walking Dead, Breaking Bad, and many others. They also own different companies as well, like Sundance, WeTV, IFC, and of course their main channel, AMC. They do also offer a streaming service as well, which I think AMC Plus, as it's called, will grow a lot in the future. But of course, in terms of streaming, AMC Plus is just a small player in the game. After all, this company is currently valued less than $2 billion US, which is child's play if you're going to throw it in the ring with Disney, Netflix, and maybe even Apple TV. This company for sure has a lot of room if it wants to challenge the big boys. But I will talk more on that later, because I do think there's something that's going to happen here in the next couple of months that could boost this company to the next level. But looking at their fundamentals, like I said, it's a $1.9 billion US market cap, a relatively small company. And usually this type of market cap I really don't like from day one, because typically there's not on the breadline, let's not call it that, not on the breadline, but it's not really what you call a blue chip company. But if you look a little bit deeper, Simply Wall Street's algorithm says that they are 60% undervalued, and their PE and PEG ratios are absolutely amazing in this crazy market where you're getting mental PEs of like $400 and $500 on growth companies. It's nice and refreshing to see a PE of 7.4. It is really refreshing to see a company with such a low PE for a change. And if we look at their PEG ratio, it's again very, very good at 0.9. This is a beautiful, beautiful PEG ratio, a price to earnings growth ratio. Now, of course, this is a relatively small company, so they do not offer a dividend, but if we look at their financial health, they're pretty much well covered. Short-term assets are coming in at $2 billion, Their liabilities are 975 million, with long-term assets and liabilities been very close at 3.45 and 3.43 in liabilities. So well covered there in terms of financial health. But the biggest negative I found with this company, fundamentally speaking, was the insider selling. Now, typically, insider selling to me is always a big no-no. Why are people getting out of this company? Well, this is quite justified in my opinion, because if you go onto the chart, you'll see that this company has gone up a hell of a lot in a short period of time. And I think it would make sense of long-term people at the company to cash out into this crazy growth, which again, the company has shown. But if we look at the chart pre-Miley Cyrus, we can see that it was around about $38 US, and we can see that it did fall down to about $20 and it hit this level 5 times, which could be an indication of clear support. I mean, just look at it. You can draw a line here and it's pretty damn clear. From November last year to March this year, it had a 300% run, which is very scary and very volatile given the fact that now it's around about $45 US a share at the recording of this video. And if we looked at the 5-year chart, we can also see it's a pretty damn volatile stock. So a lot of you returning subscribers are probably shaking your head thinking, LWC, you don't normally buy this type of chart. What is going on? And I'll tell you why. If we look a little bit deeper into the filings, and this is something I don't really cover on the channel too much, but this is definitely one of the key things in my process, we can see that their revenues and their gross profit has been little change over the last 5 years, which is really strange if you think about it. People have been locked up at home. They have a streaming service and a cable TV service. Why have their revenues not doubled, tripled like some of the other companies have? Which again should be a little bit of a concern in the back of your head if you're looking at buying this company. But I think again, that's not really that relevant if you look at the share count. If we go back 5 years ago, this company had 66 million shares listed on the market. 66 million shares that me and you could buy. But since then, they've been buying back shares at an alarming rate. Currently, 5 years later, today, they have 42 million shares issued on the market. Why is this relevant? Well, it is very relevant and one of the key features a lot of people overlook. If you think about it, let's say a company just has 10 shares in existence and you buy one of them, you own 10% of that company. After all, when you buy a company and you have shares, you are buying a portion of a business. You need to understand this. If they then buy back, say, 2 shares from the market, there's now only 8 shares. I don't know why I'm doing this. There's now only 8 shares in the market and you own 1. You now own 12.5% of this company from doing nothing other than the company taking out some shares. This company has bought back like 40% of their share floor in 5 years, meaning shareholders who had it 5 years ago own much more of the company. This is a very good thing. And inversely speaking, if the share count is being diluted, like things with Tesla, NIO, AMC, GameStop, the list goes on, it's inversely negative because your 10% could go down to 8%, or even in some cases like AMC Cinemas, much more, meaning you own less of the company. Now, another big thing to look at is what is their free cash flow and is it growing or is it stable? Now, free cash flow is very important. I think one of the most important metrics when you come to value a stock, because you get to see how much this company has left over from paying bills, paying staff, paying revenues, what is left over at the end of the day to reinvest into the company, pay a dividend, or buy back shares. This is, in my opinion, the most vital point of looking into filings for any company, because you want the company to grow that you're buying into, and if their free cash flow is negative, they're going to need to dilute you. See previous point a couple of seconds ago. So let's have a little look at AMCX or AMC Networks free cash flow. And like I said, bear in mind, this is a $1.9 billion US company. Last year, their free cash flow was $615 million. Yes, let me do the math for you. If they just had the same free cash flow for 3 years, it's enough to cover the value of the total company. Now think about that for a second. 3 years might sound like a long time, but let me put some comparisons on the table for you. Tesla's free cash flow is about $2.4 billion and their market cap is $711 billion. That's 296 times free cash flow. Apple is $94 billion free cash flow and a market cap of $2.1 trillion, which is 22 times free cash flow. Coca-Cola, 9.86 in free cash flow, $244 billion, 24 times free cash flow. So Tesla's at 296 times free cash flow, Apple is at 22, and we have Coca-Cola, a stable company, at 24 times free cash flow. AMC Network, 3 times free cash flow. This company is an absolute steal, speaking alone on free cash flows and buying back shares. It's an absolute no-brainer that you should really do some research into this company. So we have a company that has solid fundamentals and looks absolutely amazing in terms of value. The only real negative you could throw out there is that there has been some insider selling, but again, I feel that's quite justified. But seriously, could this company continue growing? Could it continue increasing its free cash flow? Could it continue buying back shares? Can it really compete with Netflix, Disney, Apple, Amazon, all of these big players in the game with just a measly $615 million in free cash flow? No, I really don't think it could. I'll be straight with you. I don't think that's even a possibility. But I do think one thing will happen, and it's been more so confirmed over the last couple of weeks. I think that this company, it's a matter of time before somebody buys it out. Now, I'm not going to speculate who it could be, because it could be any of the previous mentioned. It could even be Walmart. We really don't know. But what we do know is we've got a financially healthy company that turns over a good profit, has good cash flows, and is only trading at 3 times free cash flow. This clearly is a good opportunity to buy into. And let's be honest, 1.9 billion is just not a lot of money if you go on the full market cap. But I don't think somebody's going to buy it for 1.9 billion. When you see acquisitions, usually they're worth like double, triple, sometimes even, 10 times what the company's worth. It's complete speculation at this point. But I think companies like Disney, like Netflix would be crazy not to be even considering putting in an offer there. And I think an offer will come eventually, and it's going to start a bidding war, because I think there's going to be many people sniffing around this great company in terms of financial health and value. But what if that doesn't happen? Should you still buy this company? Well, that's your decision, but I already did. I think that even if this company does not get bought out in the next 10 years or even ever, this company's got a good route forward. It's got loads of free cash flow, it can reinvest, it can continue doing its cable, it can add new shows. I know there's like 3 Walking Dead spin-offs already out and they're aiming to add 5. There's loads of stuff that can happen. But coming back to it, I do think an acquisition is going to happen because their CEO of 26 years just stepped down. I think with him being out the way, 26 years is a hell of a long time for any employee these days. I think that emotional attachment is going to be gone. And I think an acquisition is probably a lot more likely in the coming months. But again, if this does not happen, I'm completely cool, because I think this company will do well either way on its own. So hopefully you learned 1 or 2 good things on what I look for in a stock. And if you have found this video very beneficial, make sure you have blued up that like button and drop the comment down below, Breaking Bad, in the comments. Doing so would massively help me out with the YouTube gods. So if you have enjoyed this video, surely I deserve at least a little comment of Breaking Bad down there below. There's some discounts currently on Patreon, so don't forget to check that out in the description. When they're gone, they're gone. That's it from me. I'll see you in the next one. Take care. Peace.